Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, the #1 value investing podcast in the world. Sitting next to Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else. If this is the first time that you are tuning with us, be sure to check out all of our work. Go to focuscompounding.com, sign up for the free Gannon Gazette to get a 2,000 plus word free write-up every single week. We are going to be religious about that now. We're going to be very consistent and send out an email once a week. You will get a free write-up and also 5 investing topics from Geoff as well. So if you're interested in that, sign up on the Gannon Gazette at focuscompounding.com. If you sign up for the website, focuscompounding.com, use the podcast promo code if you'd like to save some money, which is the word podcast. And then, of course, be sure to hit that subscribe button and thumbs this video up. If you're interested in learning a little bit more about our money management services, reach out to me, Andrew at focuscompounding.com. We are going to be in Omaha the week of the Berkshire meeting, which is May 2nd. So if you'd like to meet up, grab a cup of coffee, chat in person, reach out to me, Andrew at focuscompounding.com. So in today's podcast, we're going to be doing something that we've never done before. I think, actually, just kidding. We've done this one time, 2 years ago when we first started the podcast. We were talking about recent volatility in the market. And what's today's day? I think today is the 25th. Okay. And there's been some, more volatility in the market. I said to Geoff today, I'm like, the market was down 3% yesterday. He's like, oh, it was? And so if any of our investors are listening, I know, okay, I promise. I keep up. But, and there's been more recent volatility in the market recently. So it looks like we closed again today. It's Tuesday, down 3% again. Okay. Donald Trump said yesterday the stock market looked very good to him. I wonder what he thinks right now. But this is all pretty much allegedly on the, everything that's going on with the coronavirus and fears behind that. So, obviously there's been more volatility in the markets lately. So, what are your thoughts on that? How would you mitigate it? How do you think people should react when there's volatility in the markets? And do you have any advice for them?
Well, I would, there's two separate things. One is like the overall price levels and things of the market, and the other is volatility. Yeah. And when we say volatility, we always mean downside volatility. No one minds when it goes up.
No, they love it.
So they up 30%.
We love that.
It's not volatile.
We love that.
I would say not to worry about it. And not to make big decisions on either very big down or up days for your stocks in general and for individual stocks. For most investors, I would say that. I think most investors are tempted to act more quickly than they would want to if they see things that like that. So I would also say don't necessarily go and buy just because the market is down 3% or something like that. In general, these are not any one day or usually any one week or something is not such a big difference that it's going to make overwhelm the decision of like whether or not you should be that much in stocks or whether or not you should be that much in a particular stock or something like that. Over a year, yes. So there are moves in the market over a year that would really make a huge difference to whether you should be owning stocks or not. Like last year, right, there was a move that was big enough over the entire year that really would change the calculation for probably most stocks that you'd be looking at. A 30% move or something is basically that's enough to be the difference between whether you would think you had an undervalued stock or not. Yeah.
So like when it comes to volatility in the market and you have, prices that move, and you explained this to me one time, the way that you think about it, like how daily moves, you just really don't think about it. And you really just think about like, what's the business actually worth? Right. And you think coming at it from that perspective. And a lot of people say that. But then of course, when there's more volatility in the markets, it's tougher to, still feel that way.
Right. Yeah. And I think the big thing is to focus on it's important to focus on price, but not important to focus on price moves. And the thing that kind of gets attention is the price moves. Like I wrote a quarterly letter this past quarter or whatever, which basically was explaining in part the decline in a stock, which had gone up a lot in the quarter before. So I spent one quarter before talking a bit about why the portfolio had gone up so much, and then the quarter after talking about why it had gone down so much. If I'd been writing a 6-month letter instead of a quarterly
or
letter,
once a year,
there wouldn't have been a discussion of it.
Yeah, it should have been that.
It's the timing of when it happened. So, so this explains why your portfolio was up this much this quarter, because we're measuring quarterly.
Yeah.
And if we'd been measuring, for different lengths of time, then we wouldn't have included that. So I think that the focus, like you were saying, what happens is it turns into like a narrative of it, right? So if it moves by a certain amount on a certain day, that also then gets people focused on, this is happening because of events that happened that day too.
Yeah.
Which might be true, but it's also happening in part because maybe stocks were pretty expensive going into that, or because people were concerned about whatever else, So people like to talk about the move of it rather than, what level we're at. And I think price is very important, but I think obsessing about the change in price is not such a good idea. And I tell people to be cautious about that, about making big decisions based on that. Because in essence, you're acting like, it was perfectly valued yesterday. When you're thinking, it looks cheap to me now.
Yeah.
Yeah.
Because then you're dictating your decisions based on price movements as opposed to actual business movements.
And if it really looks cheap to you now, then it must have been the bargain of a century a year ago when it was a lot cheaper,
Yeah. What about, because I think the way you think about value and the way we think about value is different than a lot of investors.
Okay.
Not saying right or wrong. There's so many different ways to, make money. But, a lot of times you have said, generally speaking, you're not going to pay 13 to 15 times, after tax earnings or stuff like that. You're because everyone says, and it's true, all intelligent investing is value investing. You're not going to buy $1 for $1.10 purposely, right? Yeah. So when there's more volatility in the market, what do you feel more secure? I guess if you own a company at, say, 12 or 15 times earnings as opposed to 20 or 30, have you found that just doesn't matter? Or
no, it matters a lot.
Yeah.
And also I did research on this, going back. Actually, it was before the financial crisis I did this research, but research showing how important normalized PE ratios were and stuff. So it's basically, I did a thing that's similar to the Shiller PE, but a little bit different way of doing it, which basically just smoothed out past earnings into today's. So instead of using this year's earnings for the S&P 500, you'd use the last 15 years of earnings, and then you'd smooth it out through a pretty simple technique. What's interesting is, one, it had a really big effect. So over 10 years in any given decade, the ones where the PEs were some of the lowest tended to be really good. But the other thing is it had a really big effect that might surprise people on things like the really terrible years. So in general, being invested, buying the market in years in which it was incredibly cheap for that decade or that whatever, had a much lower chance of having a truly terrible year. So truly terrible years, huge declines in the market, tend to be 30% declines.
So in the market or in the stock itself?
In the market.
Okay.
Those tend to be very highly concentrated in years in which actually the market was really expensive going into it. So for instance, there are big drops in the market and say around, they were spread over a couple of years, but in the very early 2000s and then again the financial crisis. And in 1929 there was one. So people blame that on the particular crisis that there was at the time, right? But the truth is, in 1921, stocks were pretty cheap, and in 1929, they were really expensive.
Okay, so cheap, what do you think was normalized PE? Or not normal, just an average?
I would say stocks were about twice as expensive at the end of the 20s than the beginning. The most of it happened from 26 to 29. But yeah, so comparing it to now, it would be... What's interesting is we're more expensive now, to be honest, on any normalized basis than anything I've seen since the .com. The only thing I compared to is .com. We've never been more expensive as far as I can tell in the market.
But how do you all just kind of, putting the shoe on the other foot? Is it a different type of expense though? Because a lot more companies now, it's not like they're have no profits or no you know what I'm saying? I mean, the .com was
it's very different from .com.
The type of company
it's incredibly different. I just mean overall as a market that it's that expensive. Yeah, that the overall market. Actually, I mean, in some ways I invested then. In some ways it was easier to invest during the .com era than it is now, because there was greater
non-technology stocks, right?
Yes. And also non-leading stocks. There was just a huge concentration. Now that's happened a little bit now lately, and it happened before at times too, where there is a concentration in the very biggest tech companies and things, So you've seen that, but that hasn't necessarily meant, unfortunately, that a lot of the smaller stocks are super cheap. Like a lot of them aren't. But, like for instance, value stocks, like people keep saying that, growth has so outperformed value and stuff during this bull market. That's true, but actually it's not that value has performed worse than normal. It's that growth has performed so much better than normal. So unfortunately, that doesn't mean that value stocks are all that cheap.
Yeah.
It just means that they're cheap relative to growth stocks. You know what I mean? So where that wasn't true, and I don't have the data here for what it was in 2000, but I'm telling you that some value stocks, especially some small value stocks and things, were actually really cheap and were performing really badly. Like on an absolute basis, were performing badly. There were some shockingly cheap things and things that actually went down when the market went up. And that happens a lot at the very last stages of the bull market, where a few stocks are the only ones making all the gains, the new highs and stuff.
Do you see that being the case today?
It's different than the .com era, but it's hard to say because they're different. The overall market is as expensive as I've ever seen, but I don't see for the most part, I don't see ridiculous overvaluation of a few companies. There's some, and that started happening not that long ago, where you have sort of things that used to be venture capital backed things going public and stuff with no earnings and all that. That's more like the .com era. But a lot more of it is things that it makes a lot of sense. But it's hard because here's the thing: like people say that a lot of it is concentrated in Facebook, Apple, Google, Microsoft now, Netflix. So that's true, but we've had bubbles before, and we've had, or however you want to put it, we've had very expensive markets before where it was concentrated in things like Coke and Gillette and Home Depot and General Electric and whatever. And you have the Nifty 50 sort of things too. So these companies are really, really big. So they're just very high prices for them at those levels, So yes, they're tech companies, but tech is now a really big part of the market. So, it's kind of like, once you're that size, they can't be growth companies in the same way for the next 10 years. They're not, those companies as a group can't really grow their earnings more than 10% a year for the next 10 years. It can't happen. One of them could or something, but all of them together, weighted together, can't do that.
Do you think when investing in, so like we always talk about our definition of an overlooked stock, right? Generally speaking is maybe a beta of less than 1.
Most of them 0.5.
Yeah, or a share turnover that's less than 50%. Sometimes it could be 10, 20, 30%. So the amount of total shares outstanding that actually trade hands per year is like nothing, and compare that to like Facebook, Amazon, Apple, it's probably 200, 300%. Which again, we're not saying those companies can't be undervalued. We're just saying maybe these are just less followed vehicles or less followed businesses. Do you think those companies will not react as much to the market downturns, or when they do react, because they don't trade a lot, it'll be bigger moves? I mean, what are your general thoughts on that? Like when it comes to the actual beta itself.
They won't react as much because they're not owned by the same people. So there's two reasons. One, they don't react as much because they can't be sold as quickly. But two, and I talked about this a little bit.
But if they are sold, then they, could drive down the price.
Then they could drive down the price a lot. Yeah. But they're not the first thing that people can sell.
So like OTCM was up 0.75%.
And then the other factor is that, so this is kind of a complicated sort of thing, and I don't know that a lot of people agree with me. However, I think that I'm correct in it. A huge part of beta, honestly, is who owns it. So when we talk about beta, the problem that I see when people say something like let's use Timberland or something. Oh, well, everyone, this is what the volatility of his stocks or something. So let's have the same institutions that now invest in stocks allocate more to Timberland.
Yeah.
Well, once they do that, or gold, or whatever they didn't used to never allocate to, once they do that, they are the beta. The reason that, beta is not specific stock risk. So it's general risk. So the reason that it's going up or down has to do with the reactions of those groups of people. So a big part of it, and you know this from the kinds of stocks we own, is honestly, like say take the fund. The fund is the most extreme part of it. You know what's in the fund. There's like no overlap between the positions that are owned in the fund in terms of who owns them, right? Most of the stock, let's say most of the shares, let's forget about float or something, but most of the shares, because you could argue about what float is, but the majority of the shares of the companies that we own are not owned by people or they're not owned by institutions, and they're not owned by individuals who deal in liquid stocks. They're owned by people who intend to own them for the longer term, or who have some specific connection to the industry and invest on that basis, or who are specialists in like microcap stocks and illiquid stocks and things like us. They're not owned by the people who own Coke and things like that.
Yeah.
So,
or like just institutions that do these general like market like rebalancings in different asset classes, or
So there's absolutely nothing wrong with the idea that Apple could be really cheap, or
of
Bank
course
of America.
not. No,
But you can't say that Bank of America and Apple aren't mostly owned by the same investors who own most of the things in the S&P 500. Like the reason why the beta of something is, so what I mean by that is you can't like get away from beta by having everyone move there. You have to go away from the crowd to end up with beta that is not going to look like that. If the whole crowd moves into other things, then you're going to actually see the beta get closer, and just correlations between different asset groups get closer together. So like, honestly, people say, well, this is a safe haven or this isn't. So say gold is supposed to be a safe haven, right?
Yeah.
But if people really invest, if the same people are owning gold as owning Apple, then you're going to be surprised how closely they move together, because the same people will want to cut back on everything and to buy more of it,
Yeah.
And so it really, if the way in which you'll have the least correlation between prices of an asset is to have the least correlation in the group of people who own the asset. That's the best way to do it.
Okay, so how do you do that?
Well, so one is like we talked about spin-offs and things. So weird things in which the allocation is to people who it wouldn't normally be to. Other ones is how the company went public. We've talked about that before and stuff. Honestly, that happens a lot that you'd be surprised with. So we have, and the fund is a good example and stuff. We know in some cases there were unusual ways in which the company went public. A lot of the stocks we own never had a real IPO. Honestly, they didn't. So something happened in which it was people ended up with shares, but it is in no way the traditional IPO. There was never a road show and the kind of thing that you would have. It's not just that it became overlooked over time. It never even started that way. And if it didn't start that way, it didn't end up in the hands of people who trade stocks frequently. And so it didn't end up from them selling it to other people that way. That, people held it for longer and all those sorts of things. So you can do great in particular stocks in the S&P 500, right? But if you're buying stocks that are in the S&P 500, you're probably going to be pretty correlated to other things there. I mean, Berkshire this year outperformed in their stock portfolio. This past year outperformed the S&P 500, right? But it moves a lot like it, obviously.
Yeah, sure.
And in part, that's because their biggest allocation is to one of the biggest components of the S&P 500.
Yeah.
And their second biggest is one of the biggest too.
I think it becomes more challenging when you're, managing clients' capital, unless you're, fortunate enough to have maybe longer term capital or a structure set up like that. Because if you're managing your own money, I don't think you would care, and I know you think about it differently than other investors do in general. But daily movements type. Look, like let's talk about this, right? So on Interactive Brokers, and Geoff doesn't know this because he doesn't use Trader Workstation. Right. There's literally a button on there that says like liquidate all positions like instantly. And you know what's so funny? I'm scared as hell of it. Yeah. Like I'm like don't even go over the tab where it has it, and I'm sure like I'd have to reroute it or like route it, but I'm just like I don't even want to touch that stupid thing, But I think if you have a business owner mindset, you wouldn't do that, right? So if you owned a bunch of companies, and it sounds so cliche and like everyone, it may sound like, Buffett-y or whatever, but maybe it's true, right? That, if you own a company, you probably wouldn't care about the daily quotes on it. And let's say you had a portfolio of 5 businesses in Dallas, Texas, you probably wouldn't liquidate it right away, because you're worried about the value of it going down tomorrow.
Right,
or
and that's
something
what I
like
mean
that.
about the beta thing, because that's a decision that someone might make to liquidate stuff.
Yeah.
That isn't specific to one asset. That's what all the beta stuff that we're talking about, all the volatility that's general to the market is coming from. It is certain people making decisions more across the board, right? Like get out of all banks or get out of all whatever.
Yeah.
Whereas that Buffett's not doing that. If he sells Apple or he sells Bank of America or he sells Coke, it's because specifically he's decided that there's something with that company that he wants to be out of.
Yeah.
So I think never do that because I want to reallocate to being less in financial services or being less in stocks or whatever.
It's like this. I mean, is Buffett a portfolio manager or is he an analyst? A business analyst.
Yeah,
he's not a portfolio manager.
Right.
He's a business analyst.
That's not the way they look at it. Yeah.
But maybe it's different because of his structure, where he has the flexibility to do that. Where other people, when you manage capital for investors, you are a portfolio manager, quote unquote, because you're also managing their expectations and stuff like that. Where Buffett has the I guess the benefit of being more permanent capital, where he's the one that has to look himself in the mirror every day, and he's the one making decisions and judging himself. Now he has shareholders and everything, but it's definitely a different shareholder base than other investors. And even in the letter that you read, I mean, it said I think he was talking about them buying back stock and that him and Charlie have their own guidelines or whatever. But if somebody wants to sell more than $20 million, give this guy Mark a call, where he'd want to, I'm assuming the company or him or somebody would buy it back, So I think it just keeps the culture of the type of shareholders that own the stock in place,
Yeah. And I mean, so the thing is that's the advantage. I know people don't think they have an advantage, but that is the advantage that we talk about, like with Mr. Market and stuff. That is the really big advantage that you as an individual investor have. There's lots of advantages that professionals have, from access to certain research that you might not have, to ability to time to spend on all these sorts of things. We take road trips to different places that you probably wouldn't do because this isn't a full-time job for you.
Can't believe this work.
But what you do have an advantage is you don't have to write a quarterly letter. So you don't have to explain why something went up and then it went down, or like.
Well, it was like what you said. I can't remember. I think it was this podcast. Okay. We've recorded like 5 today or whatever. Okay, it was because you're managing expectations. Like, okay, so if you write quarterly letters. Where if you were just to write an annual letter, you wouldn't explain a stock of being up, 30% on the year, 40 or 50, whatever it is, as being a bad year, because from Q3 to Q4, it like sold off and had some volatility.
Right. It doesn't make a difference. Whereas you might do things about, like, there was another thing I put in a quarterly letter that was a big change with the business. And so it's a very different thing. There were 2 moves, 2 stocks that moved by whatever, similar amounts, so similarly big amounts, But one of them is the sort of thing that I wouldn't talk about at all or think about on my own. And the other one is something that I would think a lot about. And there's just a difference there, with things where there's a big change in the business, right? Versus things where that wasn't the case. And doing it quarterly is a big disadvantage that professional investors have that you don't as an individual investor. But also, like I talk about, like the absolute return thing. It's okay to do worse than the S&P 500 in 1 year or whatever, as long as you're getting the returns that you want long term.
Yeah, and I think from my conversation with Trey Henninger, he DIY investing, he was talking about he doesn't care about the S&P 500. Right. He's not trying to beat it. His hurdle, I think he said, was like 10 or 12%. He's like, no, I think I'll do better than that over a year, but that's, what I hope to do. Yeah. And as opposed to comparing it to the S&P 500, now he's managing his own capital, but he's also able to invest, with that mindset and, do it. And what's interesting, if you talk to any, I don't want to say like knowledgeable person or whatever, but anyone that, I don't want to say significant money, because any money is important to the individual. I've just have heard multiple people say, if I could, guarantee X% for the rest of my life, I would be happy. And that number, if it's guaranteed, would be a lot smaller than a lot of people would think it would be. If they would say, like, if I could get, 15% for last year, that's good return. But let's bring it down. I think I heard the individual say like 12%. And this guy was a very wealthy, very good investor. He said, if I could get that for the rest of my life, I would be totally content,
Right. Yeah. But then if the, S&P 500 is up 30% or something, then you feel in a year where you had that kind of result that it's not good. Yeah. I can't tell how many people I've talked to that way, and also who measure against other things too, which is like, oh, but this other person is doing even better in this environment.
Yeah, it's hard. Yeah.
So it does matter, because obviously if you're measuring over a full cycle of things and stuff that you're doing, it should give you some indication. of how you're doing, and that if you're not having good years when the S&P 500 is up a lot, it's going to be hard to match that. But I think people pay too much attention to that in terms of like the annual things that way. If you were going to do that, I would at least say don't fixate on like a year by year thing. At least fixate on the idea of like since inception, since whenever you started measuring this, how is it done? So like, how have you done over the last 7 years if you've been managing an account for 7 years or whatever? Not how have you done each year of those 7 years.
Okay,
I think that just doesn't matter.
Let's check the other side of the coin, right? And I'm not hating, but let's say Buffett, for example, his 20% annual compounded return, majority of that was from when?
The first 33 years, yeah.
And you even said in one of our podcasts, the next 33 years is probably going to be a lot different than the past 33 years. So how do you sort of weigh those odds, you know what I'm saying? And think about how do you handicap that?
Yeah. I mean,
is it what you're trying to do? Is it, you know, like if I was indexing myself, I would just, if I wanted to index my money, I would just buy Berkshire stock. I would be like, that's probably a better index than Berkshire, or than the S&P 500.
Yeah, let me put it this way. I think now it would be easier for people to outperform the S&P 500 than you might think if you just do it in a common sense sort of way over the next 10 years or something, because it's pretty expensive. And there are other things that could be easier.
But how? So are you bottom fishing for value? I mean, what are you doing?
I've said that I don't think that Berkshire will compound all that well, but I wouldn't be. But Berkshire actually has a pretty good chance of outperforming over the next 10 years compared to what it has been at other times in the past. I thought it had a pretty, like if we go back to late 1990s, it had a really hard time because some of the things were really expensive that it owned and stuff like that. And so I don't. You know, it's interesting because like I know what my returns have been since I started investing my own money and then managing money for other people and stuff. And you'd be surprised how little they varied on an absolute basis, and yet how different people feel about that over time. You know, so like they would say that you were a genius in the period, like all value investors, right after the dot-com bubble burst. Yeah. Because on a relative basis, you were putting up incredible. I mean, it would have been, you were outperformed by 30, 40 percentage points or something incredible. But that's because the market was going down while you were going up by the same rate. Yeah. And then that same rate, when you do that in a bull market, is not that impressive to anyone. Yeah. You know? So I think that, I think it's very hard to not focus on the relative returns to the S&P 500, but you should do it, except we do have to keep in mind that most people are pretty heavily correlated to the S&P 500. So it is true that if you're lagging behind, you have a pretty significant correlation. So the way in which you're lagging behind may be an indication that you're going to do worse over time than the S&P 500. Whereas if you were in something that was very uncorrelated, it shouldn't matter. So you really shouldn't be paying any attention to it.
Well, which is
we unfortunately report it, even though we know that we have like very little correlation with it.
Well, that's what I say. It's a double-edged sword, right?
But we know that other people can pick it. Yeah. So we know that our clients can pick the S&P 500 instead of investing with us. However, the reality is that what the S&P 500 did has very little bearing on what our results will be. But in the like overall, I want to invest for the long run, they could pick an index fund or us. You know?
Well, I was going to say, it's a double-edged sword, right? And it's like if the market rips, I don't know, 30% for the next 20, and of course that's such an extreme example. It's like, would we keep up with that? I don't know. But if the market falls, you know, X% for the next, you know, same amount of years, would we keep up with that either? I don't know. You know, I don't think so. I think it's just whatever it'll be based on the stock picking abilities.
Yeah.
And you know,
I mean, my preference honestly would be not to compare to the S&P 500. And I mean, to compare occasionally or whatever in the sense of here's what your results might be. Like the S&P 500 since Buffett took over Berkshire did 10% a year. I think most people would be better off just thinking, can I do better than 10% a year? Yeah. If that's all they thought about, instead of can I beat the S&P 500,
then what did it do this year?
They would sleep a lot better and stuff. That's good. It's
like
it's a very simple number.
Yeah, I like that. I like that a lot. I like that. Let's see, how long are we on here? Do you have any other thoughts on what's going on in the market?
I don't really.
How do you think people can, let's say, guard against it? And look, I don't want to be the guy that's like, we're just off 6%. Let's talk about the market. But I mean, people are asking us, so why not? And we never do content like this.
Yeah.
And it's, I guess, whatever. But I would think that's a good gauge to use. That's a good mindset. If you can do better. And Trey Henninger, shout out to him because he explicitly told me that.
Yeah.
He's like, I don't care what the market does. He's like, people could do whatever percent. My personal goal is 10% a year. I think I'll do better than that, but that's my personal hurdle. I think he said 10.
Yeah.
You know, so maybe that's a good takeaway for.
That's also
lot
not a
of people
bad thing
listening.
for a lot of other aspects of your life. I mean, we're talking about the difference is the relative results versus the absolute results.
Yeah.
You should learn to be happy with good absolute results. And so, you know, be happy that you have plenty of money and not whether you're the richest person on your block. But that's the same sort of thing with the S&P 500 thing. It's, oh, well, I didn't maximize it to the extent I could have. But if you hit your goals in terms of when you wanted to retire and stuff, then that's really why you were investing, not to like, you know, match some number from the S&P 500.
Yeah. Cool. Well, that is good. Well, I want to thank everybody so much for tuning in. I'm going to give Geoff a round of applause because he's feeling a little bit under the weather today, and we just recorded 5 podcasts. I'm on like a 20-something hour fast. So I'm about to go get a Chipotle burrito. I'm about to get out of here. But I want to thank everybody so much for tuning in with Geoff and myself on today's podcast. We are going to be in Omaha the week of the Berkshire meeting, May 2nd. So reach out to me, Andrew at Focus Compounding, if you're a prospective investor and would like to learn a little bit more about our money management services. If you see us, anywhere, come say hi. Come talk to us.
Okay.
Take a selfie with Geoff. Take a selfie with Geoff. That's all I'm gonna do. That's all I'm gonna do. On my Twitter thing, it's just gonna be a bunch of pictures of Geoff and whoever comes says hi. So be sure to do that. And I want to thank everybody so much for tuning in with Geoff and myself. Hit that subscribe button, thumbs this video up, leave us a rating review. It goes a long way. And we'll see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.